Well, we've hit you with a lot of stuff so far, both good and maybe a little less so. So let's try and put it all into perspective with Alec Young. He's global equity strategist at S&P Capital IQ. Mr. Young, welcome. Good to have you with us. You know, some of the Chinese data that came out today and over the weekend caused some worries. Should investors here in the United States be worried by rising Chinese inflation and falling industrial production?
Well, I think there's certainly trends that we want to monitor, but a lot of the inflation pressure was coming from food, which was up 6%. Ex-food, it was only up 1.9%. So a lot of that 3.2% increase in Chinese inflation was driven by food, and we think the New Year holidays in the late January, February timeframe had a lot to do with that. As far as the industrial production, that also could have been impacted by the Lunar New Year holidays. So I think we're going to want to see a little bit more evidence of this slowing growth, increasing inflation trend before we need to get too worried about it as U.S. investors.
Alec, you heard all of our reports about the stock market going up, other issues and headlines out of Europe. Tyler just talked about China. A lot of investors seem to be preparing for some kind of pullback. What's going to be the trigger? Washington, China, Europe?
Yeah, I think that's the challenge. Everyone's looking for the pullback, but the trigger remains elusive. I think there's a couple of things that we're going to be watching in the second half of March. Number one, we have the next Fed meeting around the 20th of the month. And obviously speculation with growth picking up is going to continue as to when the Fed starts to taper their QE program. So that's something to watch. Another thing, obviously, is the ongoing resolution deadline in Congress on the 27th of March. They need that to fund the government and avoid a partial shutdown. So I think if investors are looking at potential speed bumps going forward, those two events are things to keep an eye on. But overall, we think that equities are pretty well positioned here. The economic data is generally coming in better than expected. And I think that's giving people confidence that corporate earnings are going to continue to grow. So while we could have some short-term speed bumps, we would urge investors to not get too dramatic in any of their short-term reactions.
You know, if I infer from what you say there that you're not in the camp that expects a 5 to 10% correction, and if I'm right, or maybe even if I'm wrong, what would you suggest I do with my money given the scenarios that you foresee?
Well, I think one of the earlier guests that was quoted in the program said, you know, it's not really about timing the market, it's about time in the market. And I think I would generally echo that. If we look at the number of people that have been looking for pullbacks, you know, myself included over the last few months, and the results that it's gotten us, I think it's a reminder that, you know, trying to time the market on a short-term basis most of the time ends up being a fool's errand. And over the long run, equities are definitely where people want to be, especially given the lack of attractiveness that we're seeing in bonds these days.
I was just going to ask you about that because you heard our report about 401ks. People are looking at them, trying to figure out what to do. What's your advice to investors? Time to rotate out of bonds? We've been, you know, having a lot of discussion about it. Where do you stand on that? Time to get into stocks?
Well, hopefully people already have some exposure to stocks and they're not fully exposed to bonds. I think, you know, some rebalancing maybe is always a good idea. But I think overall, people that have a lot of time until retirement should continue to take an equity focus. If they don't own quite as many stocks as they should, you know, now is as good a time as any to get involved, but maybe take a dollar cost averaging approach so that if we do get a bit of a pullback, you know, they're going to be able to take advantage of that with some dry powder that they may have.
All right, Alec, on that note, we leave it. Alec Young of S&P Capital IQ, thanks very much.